There are only two certainties in life: death and taxes. And obviously, death has been on my mind recently. It's why I've been chatting a little bit about life insurance. And that point was driven home again last night when we recently had a death in the family. So I'm going to talk just a little bit more about that. We've established that you should have term life insurance. But now the question becomes, okay, great, I'm supposed to have term life insurance, but how much life insurance do I need? There are several methods for calculating out how much life insurance you need, and I'm going to put a link to a decent calculator that I found in the description below this video on YouTube. For the most part, I prefer a variation on something called the DIME method, because it takes into account several factors. It isn't just a guesstimate based on how much you earn. And I like it because it's more involved. It actually asks you questions not only about your current financial situation, but what your plans are for the future. So, with the DIME method, DIME stands for debt, income, mortgage, and education. The debt portion is where you're supposed to add up how much actual debt that you've got plus funeral expenses. So, for an individual, funeral expenses, an average is around $10,000. It could be more or less, depending on you, your family, and the choices that you make. But that's a good starting figure to work with. And of course, your debts is looking at credit cards, student loans, signature loans, medical bills, car loans. I may have mentioned it twice, but it's important enough to throw it out there. Can't hurt. So there's all the factors that come into play when thinking about your debt. Your income, it's looking for how long do you need to replace your income. The reason for this is, especially if you've got, say, children or somebody that relies on you for care, well, then they would need to be able to replace the income that you were earning in order to continue to survive without having to have their life completely upturned in the process. So, in the case of if you've got children, one way you can look at it is to take whatever your annual salary is and multiply it by 18 because they're going to be dependent upon you until they're an adult, right? Beyond that, your mortgage should be self-explanatory. How much money do you still owe on your home? Whatever that number is, that's what you want to factor in when trying to determine your life insurance needs. And lastly is education expenses. Now, I have talked about how I'm not a big fan of paying for education expenses. It's referring specifically in the DIME method to how much of your children's education expenses do you wish to pay. I think there's other options. I think we should let our children find their own way to pay for their own education. There are scholarships, grants. Of course, they could work during that time. But just in case part of your legacy is that you want to pay for your children's education, you can factor it in. Now, something else that the DIME method doesn't quite factor in is value that you bring to your family. Is there things that you provide that they're going to have to find some other way of replacing, specifically monetarily? For instance, in a single income home, the death of the breadwinner, if your spouse is left behind, they might have to go to work, things of that nature. Childcare would come into play. Maybe you were able to reduce the cost because you did all of the mechanical and home repairs, and your spouse is not mechanically or structurally inclined. We'll just go with that. Okay, so you're supposed to take that into account too. There's some unknowns that you can take into account when it comes to factoring life insurance. So once you've got all of those figures added up, you're then supposed to deduct whatever savings you have and whatever other life insurance policies that you have. Now, the one caveat here is you do not want to deduct life insurance that you have through work. Because employment could change, because you could get laid off or fired, you rarely want to factor in you don't want to count on whatever life insurance you have through work. You want to treat it more as a bonus, whatever it may be. And that's a mistake that a lot of people make. Perhaps I'll address that in another video, but just take my word for it. You do not want to factor in insurance that you've got from work when you're trying to come up with how much life insurance that you need. So in the examples that I've given you so far, let's say a person has roughly $80,000 in debt, and funeral costs will be another $10,000. By the way, that $80,000 comes from credit cards, student loans, car loans, medical bills. It's not much, but it's a rough ballpark figure. Funeral costs $10,000. Income replacement. So let's say you have a baby on the way, so you're going to need to replace your income for 18 years. Well, let's say you earn $35,000 a year. 35,000 times 18 years is $630,000. Mortgage. Let's say you have a $200,000 mortgage. That's what you still owe on your home. And as far as education costs, I've covered that in another video. Remember, I said that it could be anywhere from $55,000 to $130,000 for that degree, depending on whether you're going in-state or out-of-state. So let's say we meet in the middle somewhere and just assume education of $80,000. Okay, these are all modest numbers, I hope you could see, but the grand total, when added all together, is $1 million. That's how much life insurance you would need. Now, assuming you're 25 years old, a 20-year level term policy, assuming that you are in good health, would cost you roughly $38 a month. It's going to vary some based on your location. It's going to vary based on current health condition, things of that nature. It's also going to vary based on whether or not you smoke or not. But I ran these numbers just before coming down here to share all this with you, and this is what I've come up with. Now, that $38 per month is, if you multiply that times 12, you'll come up with roughly $456 a year. Now, mind you, with insurance premiums, a lot of insurance premiums can be cheaper if you pay them on an annual basis instead of on a monthly basis. This is true of car, this is true of home, and life, for sure. So there you have it, some very rough estimates on what life insurance costs would be on a 25-year-old in good health. $38 a month, $456,000 a year. If you and your spouse are both getting coverage, well, then that is $76 each month that's going to be going out towards insurance costs, which then becomes a significant expense. So it is certainly something that you will need to factor into your budget. Now, I hate to keep belaboring this point, but people don't like talking about it, but it's something that you should talk about sooner rather than later. The sooner you sit down and make these decisions regarding life insurance, the cheaper it tends to be based on your age. So having this discussion early is important, especially if you have started establishing a family, especially if you've got somebody that is dependent upon you for care. As always, guys, if you have questions, hit me with them at fustyandfinance@gmail.com or leave them in the comments below this video if you're watching on YouTube.